Everyone, and thank you so much for coming today. I'm super excited to help kick off Disrupt with this fun panel on how to raise a Series A. I'm Dominic Midori Davis, a reporter here at TechCrunch, and I'm joined here today by Thomas Krane, a managing director at Insight Partners, Katie Stanton, the founder and general partner at Moxxie Ventures, and Sangeen Zeb, a general partner at GV. We will be doing audience questions, so please start thinking about what you want to ask, so near the end we can answer them. But before we dive in, I will just give everyone just a brief moment to further introduce themselves and their work. Would you like to begin?
Sure, yeah. Hey everyone, Thomas Krane, Managing Director at Insight Partners, New York-based fund, kind of multi-stage in terms of our focus, just on growth software primarily in terms of markets. And I've been with the firm for 13 years, actually started as a summer intern. So it's been an interesting journey, and I've seen the firm grow a lot over those years.
Hey everyone, my name is Katie Stanton. I'm the founder and GP of Moxxie Ventures. We're an early stage pre-seed and seed fund. We talk about software solutions to hard problems that help a lot of people. We are former operators. My background is as a PM and biz dev person at Yahoo, Google, Twitter, and Color. And then my partner, Alex Redder, was head of engineering at Twitter. And Ashwin and Pratik, who I think may be in the audience, they're former engineers and are former founders. So excited to be here today.
I'm Sangeen Zeb. I'm a general partner at Google Ventures out on our West Coast office. We're a multi-global, multi-regional fund, multi-stage as well. We're the independent venture arm of Alphabet. So that means we're going to invest in a bunch of cool companies that have nothing to do with Google. For us, that's like Zipline, Robinhood, Stripe. And we also get to invest in products that compete with Google, like Uber and Slack. I'm on the boards of Vercel, AI company called Harvey, which is AI for lawyers, and Open Evidence, which is AI for doctors.
All right, let's dive in. It seems like so much has and hasn't changed with what it takes to raise a Series A in the last few years, especially with the AI companies getting so much money. My first question, really for all of you, is what is the biggest change you've noticed in what it takes to raise a Series A today? Thomas, would you like to start?
Sure, look, I mean, there's no doubt these are big markets. There's a lot of white space that's being taken that, for the most part, we're not seeing it's a displacement of SaaS. It's actually kind of new white space that can be addressed in a way that these workflows just weren't possible before LLMs. So a little bit of just trying to understand where the problem space is that these companies are addressing, and understanding why that's not necessarily going to be an adoption cycle that is inhibited by kind of like traditional sales and go-to-market. It's more of a true bottoms-up type of adoption wave. So, it is marrying that value prop, that white space, and that go-to-market in a sort of set of ingredients that we've never really seen before in kind of this wave of LLMs.
I think for us, one of the things that we're observing is that it has never been easier to start a company, and it has never been harder to build something that is defensible and something that's really durable. And it feels like so much of the builders right now, it's like you're building on quicksand. Like things are moving just so fast. And when we see a lot of these deals, we're like, wow, that's really interesting. But like, can OpenAI do this in the next release? So increasingly, while things are moving really, really fast, I think from a VC perspective, an investor perspective, we sometimes have to kind of pause and really think through that there are so many of these really interesting AI companies out there, but are there really big AI businesses out there? And how do we make sure that we're betting on those teams that can really build something that is defensible and durable?
Yeah, look, I think for us, we have a lot of capital. We have a big fund like Thomas. And we've come at the AI stuff with a ton of enthusiasm. So I think we lean into our Series A's. We're pretty excited and been deploying capital pretty rapidly. I think one of the repercussions of the downturn in 2022, though, that we ask ourselves is, not every company needs to blitz scale to success, right? They don't need to raise hundreds of millions of dollars. And so the thing I think we push the most on is, hey, if everything can go right, can this company be truly, truly massive, right? And we see that, for example, with Harvey. They're past 100 million of ARR. They're going to triple this year, right? And that is a business that, is going to be very, very large, and so we push on that a lot. We'll sit in the room with our founders and actually say, like, does this company need round after successive round of funding? Like, is it an appropriate venture-backed business? Venture is an expensive way to finance your company.
Have Series A rounds gotten bigger in the past few years?
I mean, go ahead.
There was a Carta study recently, and I think the data there was that the number of rounds have, at least in the first half of this year, the count has gone down about 18%, and the sizes have actually gone down 23%. But what's interesting is that the valuations have actually netted up. I mean, it depends, obviously. Like, the AI companies are raising at very high valuations. But I think what that means is that at Series A, and you guys are the Series A investors, not me, but at Series A, they're getting pickier. That there are just so many VCs out there. There's so much capital out there. Are there really enough of these high-performing, high-growth, sustainable, durable companies that are worth betting on? And so those valuations and those deals tend to get marked up quite high.
And to Sangeen's point, a lot of the bigger firms, including ourselves, have gone earlier, just by virtue of, if you look at, I think the average is like an 8x increase between Series A and Series B valuation with 8 months of data on these kind of AI high flyers. And then it's another 8x increase after that, or at least 4 to 5x. So you have to go earlier, and then that, of course, creates the scarcity value that ultimately drives the round sizes up.
Yeah, we did an analysis of the AI companies we wish we had been investors in. And at the end of last year, the Series A's were still in the $20 to $30 million range. Those have ballooned up. Now they're closer to 30 to 40. But the bigger jump was at the Series B, because once you saw some sign of inflection by the B, those rounds went from 20 to 40 to now 50 to 70 million. We've written $50 million checks into Series B's, which is like pretty novel for us. And so the time for a new round is accelerating, and the rounds are getting much, much bigger. I mean, that extends even further at the Series C now.
Is that good or bad that they're getting so big?
Well, I mean, if you look at capital, to Sangeen's point, it's not necessarily a good moat. And it's been proven that capital, I think if you look at some of the case studies of the very big firms that tried to use capital just as sort of a driver of moat in these companies, it didn't play out universally so well. And so, look, from the founder's perspective, if you can raise it, okay, I understand the rationale, but it's going to set the bar high, and you always have to be thinking about, okay, if you're taking an investor dollar at this valuation, their expectation, especially at Series A, is at least 5x or more. And then that's going to, of course, put some artificial constraints in terms of how you orient the company and ultimately the strategic outlook for the business.
What do you all look for to know when a company is ready for a Series A? Like, what do you judge them by?
For us, I mean, we actually have a formula, because we went back and looked at some of the Series A's and that we were happy we did, and those that we were less happy we did. And I think what really stood out to us is at that stage, people talk about, okay, you want to see product market fit, but what does that actually look like from an analytical perspective? And it's pretty simple. It's just quarter over quarter, or in some cases, month over month, sequential increase in new bookings or new logo acquisition. Just something that you're growing through, just kind of at this stage, there should be enough pent-up demand and enough market space that every quarter should be your best quarter. And that sequence should be happening, consistently and sequentially.
Yeah, what I would add to that, I mean, obviously product market fit, but the number one thing and the big word for us is just velocity. We're in a company, and this may get spicy, but we're in a company called Spellbook, which is another AI for lawyers product, which is growing fast, maybe a little bit faster than Harvey now. But they're an awesome team, and when we invested, we led their seed round, and when they were ready for their Series A, it was all about velocity. The team was growing, or not the team, but the product was growing, revenue was growing, the number of customers were growing so quickly that we knew that they were ready for their Series A, and that has only continued throughout their fundraise process. So for the founders in the room, like really, you are transitioning from seed to A. Seed is all about vision. Your Series A is all about velocity. Can you prove that you can repeatedly sell? Can you prove that you can repeatedly grow in a big and growing market?
Yeah, at the A, I think it's two things for me, at least personally. One is I really do sit with the founder to say, hey, look, your end goal at all of this, right, from here to one day, hopefully you're a public, very large business, is to own as much of your company as possible. And it's not worth even taking this money unless you think it can be a really big business, right? Most companies should not venture scale. They should not take hundreds of millions of dollars. Like, most businesses can go 20 to 50% forever, burning very little cash, and you will own a ton of your business. So the first thing I do is try to convince them not to take my money, or anyone's money, right? Like, build your business in a normal way. I think blitz scaling is very inappropriate for most companies. The second thing is, if I can't convince them of that, is really try to understand some magical insight towards hey, prove to me that this market is way bigger than even I realize, right? You think of something like Stripe. I think people underestimated the size of that business, and I think the best founders can articulate why to you it's so much larger than you realize. And the last thing I'll say, which has been great, is a lot of our seed companies, a lot of our Series A's companies, those companies, worst case, have been aqua-hired to our bigger companies. We just had that with Open Evidence. They aqua-hired a seed deal of mine, and that has worked out great, right? The founders are very happy there, and then for the company, having that founder energy and that founder speed back into parts of the business have been awesome. And so I do think we're operating in a world for these early stage founders, if they're truly special with very limited downside.
What is something that, when it comes to founder pitching you guys, what is something that kind of gives you the ick? What are the red flags that you look for when a founder is pitching?
I mean, look, I think we see it all. There's a little bit of that, the name dropping, a little bit of trying to play the round off of people, maximizing optionality. I think at some point, you're going into a marriage. It's actually even more than a marriage, because you can't get divorced. So you really have to feel like there's trust and relationship and rapport, and that you can have hard conversations, and that you can argue and still come back together and work through a solution. So if it feels like this is purely a transactional sort of process, that to me is just a huge turnoff.
Yeah, totally. Obviously, just don't lie. You find out, and to your good example, we think about this a lot too. It's if you're dating someone, you're I really don't want any kids, and then you get married, you're yep, we're having 5 kids, and that just doesn't work out great. So just be really honest, be transparent. You are in this for the long haul, and one of the things we tell a lot of founders too, and it goes both ways, that you're obviously doing reference checks on your VCs. You should always reference check VCs with other founders, and especially with founders who have failed, because it's really easy to have something great to say when things are awesome. What do people say when things are really tough? That's when real true character is revealed. So just be as transparent and long-term thinking as you possibly can.
Yeah, I have the fortune and misfortune to see companies get very big and then plateau at different points for different reasons. And so trying to assess from the founder, what is the underlying thing that is propelling you to do this? And is that sustainable? I don't fault anyone for, you've done some secondary, all of a sudden you're very wealthy, right? Does it change motivation? Does it change drive? We've seen that. And so it's spending a lot of time with the founder to be understanding their psychology, right? Will that maniacal drive to build a very big company change at any point? And so I think the more honest they are, the better it is and easier it is to sign up for that journey with them. Because as Thomas mentioned, the truth is any one of us, we can't do beyond a certain number of deals. We can't invest the amount of time that is appropriate. And so that is a high bar.
And you end up spending more time with the ones that are challenged. I mean, I love to spend time with the winners because it's great. You show up, they hit their numbers, things are good, but it's the ones that really, and to your point, Katie, spending time with or getting the references on the situations that didn't go well, because that's really when you see the investor true colors.
And this is something I'm just curious about because AI companies, they grow so fast, and technically those growth rates might not apply to every industry. And this is kind of a niche reference, but it reminds me of when the artist Halsey was saying that like her record label was judging her by Taylor Swift metrics, but Taylor Swift is Taylor Swift. And so I'm actually quite curious to know how investors are judging non-AI companies these days compared to their AI counterparts.
I mean, so at Insight, I feel like we've done a pretty, interesting job just using our scale to somewhat shift our strategy on the fly based on the market conditions and the opportunity set that's in front of us. I mean, we're talking to hundreds of thousands of companies globally, really boiling the ocean bottoms up through our analysts and outbound team, 80+ folks that are really cultivating these relationships almost at inception, oftentimes, with the founders. And many of them are not AI native companies. Some of them are companies that you wouldn't think are necessarily fit for the traditional growth or venture model, think like salmon fishery monitoring software, for example. And these are companies that bootstrap themselves to like actually reasonable scale, 10, even 20 million. But they're not going to go raise a traditional Series A. And for us, we find that as a really attractive sort of asset class for us to build, kind of really, apply our company building expertise to help those companies take them to the next level, but they're not necessarily going to be IPO, unicorn type businesses, but we think they can accrete a lot of value, and in some cases, they're what seem like kind of niche markets are just in early phases of really mass adoption, and some of those companies have ended up getting very large.
I agree, and also it's awesome having Thomas being to your left because he gets to go first every time, so I get to riff off of him, which is awesome.
I'm going to make you go first now.
So AI, obviously, like so much hype, so much opportunity, and there's a lot of excitement, and it's all very well deserved. But there are so many hard problems in the world that need to be solved in deep tech and medicine and healthcare and robotics. And many of you are probably in those categories. And so, encourage you all to, keep building and keep solving these problems. And I think one, founder and team that comes to my mind that I think is a great representative and answer maybe to your question is a company called Zone Homes, which is providing a great service to homeowners. It's not necessarily AI, but it's in the embedded finance case. And for them, they have a product that customers love. You look at the Google reviews, and people are like, this is the best thing to ever happen to, to home buyers, to make it easier for them to afford a home. And then you look at the team. Those guys, I remember Ashwin on our team went to go visit them, and he was like, I can't be the first to leave. It's 11 o'clock at night. This team is so dedicated. They're working so hard, and it's reflected in their metrics. They have great revenue. They have great retention. They're growing, all these things. So, keep relying on those fundamental metrics that you have and customer love. While you may not be in AI, showing that customers love you, the market's pulling for you, you have these repeatable, amazing growing metrics, I think you'll be in amazing shape.
Yeah, to Katie's point, we just backed a frontier investment in the fusion energy space.
Wow.
And
which one?
Right, I can't say yet, but a founder we're very excited about. Look, the odds are it may not work, right? We go into these things very eyes wide open, but we ask ourselves, if it does, right? And OpenAI is like a great example of this. Like in the early days, it was a research lab, it was a nonprofit. There was this question of like, what will it become? Here we just said, if there's any chance it works, it's worth leaning into, and it's a founder that we're very excited about both investing time and dollars in. And so again, the bar is high, but if the outcome can be impossibly huge, we'll take that risk.
Yeah, my next question was actually going to be like, how can the non-AI companies stand out to you while they're pitching?
How can they what? Sorry.
Stand out.
Oh, stand out.
Which?
I mean, metrics, right? Like, these, most venture capital firms, they're banks, and the ATM password is going to be traction, right? And so, like, if you have the traction to be able to unlock, I think that's great. And the other thing that I think might be as an underrepresented, category is just like tenor? How passionate is this founder? This is such a long ride. Like, why are you doing this? And if you kind of feel this energy, and this is the founders or the team's life work, that goes really, really far. So make sure you have that.
And, oh, sorry, did you want to?
No, you nailed it. Passion's number one. Still the most important thing, right? There are great consumer companies, there are great frontier companies, there are amazing companies we meet every day where we just want to go on the journey with that founder.
And some of the non-LLM, non-AI companies have the advantage of a really predictable long-term cash flow model. I mean, it's the things that have gotten investors so excited about software for so long. A high gross margin, highly recurring revenue, very sticky, relatively low cost of sale. And so a lot of those fundamentals are really thrown out the window with certain LLM-based companies around gross margin, around retention, and that calls into question sort of the long-term valuation and potential of these companies, even if the traction in terms of the inbound demand is stronger than we've seen in typical SaaS adoption cycles. So just because you're not AI doesn't mean you don't have a very attractive sort of asset, intrinsic quality to you.
And I wanted to ask a question on the flip side, kind of about AI companies, because it seems like so many companies are using AI and everything is AI now. How do AI companies stand out when pitching you when it seems like so many companies are so similar?
I just don't want to be the first one because I've been.
We'll start with.
No, I can. I mean, look, again, at the end of the day, I think we go back to the value prop, time to value. How big can the ASPs be? I mean, we look at some of these markets where you've got large incumbents that kind of signal, okay, within a certain vertical of software, look, you take Epic, how much revenue does Epic have? I don't know exactly what the number is, but then you comp that to what Ambience or Abridge or these other, kind of digital scribe companies are going after in terms of their own, what their new valuation has to imply in terms of future revenue and market cap. And the numbers can start to become tricky. Plus you have OpenAI and the big platform companies, plus the old school incumbents that are building their own solutions. So I guess at the end of the day, we try to understand, like, if it's a market with a lot of competition, both incumbents and next-gen competitors and platform players, like, what is going to be the standout path? And ultimately, I think especially at later stage growth, the numbers become very tricky in terms of what has to be implied, in terms of a lot has to go right. Then, of course, we're oftentimes humbled with how amazing these companies go out to perform, like Harvey's of the world. So.
Yeah, one thing I would add is industry expertise. So obviously, like, having AI engineers, again, table stakes if you're building an AI business, and everything is basically AI at this point. But increasingly for us, we look at vertical applications in AI, and it is such a great winning model when you have that combination of technical expertise and industry expertise. So with Spellbook, doing AI for lawyers, they have one of the co-founders is a lawyer. Keith Raboy just led their Series B, and he is a lawyer. And that's really helpful to have that sort of industry expertise. We backed another company called Pharos Health, which is AI for patient safety data, working with hospitals. And Felix and the team, they're both really talented engineers, but they have all this amazing experience selling into hospitals. And I would say, that especially in healthcare, you know this very, very well, that you can be the most brilliant software engineer, but if you're selling into healthcare systems, that may take a long time. You really need to have that credibility, that industry know-how, because those sales cycles are very long and the stakes are very high.
Weird answer on my part. I'd say the common underlying theme of a lot of our founders that are doing well is just paranoia. and admitting, like, I remember the Harvey guys came in at the B. There was this question like, do we need to build a massive AI team? What is more important, domain expertise or having AI luminaries and constructing your, like, we were talking about building our own models, right? But they, in that meeting with an investor they just met and presumably wanted on their cap table, they were very honest of, like, we actually don't know the answer to this question. What do you think? And we argued back and forth, right? And the thing that's true about them, that's true about the founder of Open Evidence, that's true of, like, Mira Murati at Thinking Machines, who we backed, is, like, they're keeping pace with the rate of change, which is a very, very hard thing to do right now. There is a model out there that is faster than the previous generation, that's better. They're open source models. Even the way applications look going forward is going to change. And the commonality amongst all these people, from Mira to Ilya, who we back, to the Harvey folks, is we have to move faster. And that has been the underlying theme of all those founders.
Where did you land on your debate to
At the Series B, which unfortunately we missed, we invested at the C, I was kind of pushing back that, like, I don't think you need these people, right? I don't think, you don't need to go out and give a ton of the company to some AI luminary, right? Now, it's great to surround yourself, bring them on as advisors, but the view was, I think the models get better, and it's more, can you build quickly on top of them and not be wed to any single model? I can be wrong 5 years from now. Right.
We're having the same debate at another company.
Yeah.
No, that's why I ask. I mean, if your roadmap is converging with Anthropic or OpenAI's roadmap, you might think about whether that's the right use of your precious resources and engineering capacity.
I'll give the Harvey team credit, which was like, we'll burn it down if we have to. If we're wrong, we will move as quickly as we need to, and that was sort of the ethos for day one, which is admitting, like, we don't know what's going to happen. We just need to know we can adapt very, very quickly.
I think we see, actually, it's really interesting. I don't know if you guys see this too, but first-time founders are very excited about how large their engineering teams are getting, and second and third-time founders are really excited about how small their engineering teams are getting, right? And so, so much about this is all about scale and efficiency, and especially with AI, like all the turbocharging that can be done with, and the speed that can be done with smaller teams.
And I'll ask a few more questions before I'll pass it to the audience. One of which is, I want to talk a little bit about preparing for a Series A. How soon after a company raises a seed should they start thinking about a Series A?
Same day.
Before.
Before, exactly. You're always fundraising. See, I'm going first.
This
so
is good.
everybody
This is
care.
good.
I think that this was a Carter number that I have in my head, but it used to be, the time from seed to Series A was about 18 months, and now it's taking 20 months. It's taking a little bit longer, and that's, again, because I think the Series A firms are just getting a lot pickier and looking for, capital efficiency and velocity and sustainability and defensibility and all these things. So, you should always be ready and be thoughtful. We actually ask at seed, we don't necessarily expect an answer, but who would you like to raise your Series A? Like, is there somebody in mind? Because we want to make sure you're thinking long term, and we have relationships with all these amazing Series A firms. We want to make sure we're matchmaking. And so you should always be ready, but you also don't want to go out too early. If you're not ready and you start showcasing and you're ready for the A and you're not, word gets out really fast, and it can actually have, a really negative effect on that fundraise.
I encourage my companies to raise as little as possible. So I have a little counterintuitive example. And, when they're doing well, the A's will find them.
It's interesting. I kind of have a different view, which is, you have to go out there and test the story with the market to some degree. And, I think that a lot of the firms that have more of an outbound team, Insight being one of them, like that relationship and that trust and rapport that you establish with the analyst early on, I mean, they're going to be, ultimately, they're the ones to steer you through the halls of Insight or whichever firm you're talking to. And you want them to be empowered and feel like they can trust you, and vice versa. And if you do well by them, they're going to do well by you, and make sure that your story is articulated thoughtfully, and that you've got credibility with the firm that you're talking to, because you've kind of maintained a relationship and maintained a dialogue that, to us, that matters more than you're the hot company with 10 term sheets. For us, how are we going to differentiate in that conversation?
Yeah, probably my last question for audience questions is, what can a founder assess about an investor to know whether or not they want to raise their Series A from them? Like, what should they judge you guys by?
I mean, look, we've spent a lot of time investing in terms of the company building and sort of productizing a lot of the best practices. I mean, I think at Series A, it kind of boils down to two things, which is help me find customers, help me find talent. And we've done some pretty, I think, innovative things from a venture firm perspective, using our scale again a little bit to our advantage. So we acquired a business called Riviera Partners, which is a large executive search firm for product and technology roles, which gives us a lot of great sort of visibility into some of the best talent out there, and especially around AI, it can be really creative. So looking for what are those firms that kind of go the extra mile in terms of the edge, and oftentimes scale is what enables that. You've also got, on the flip side, I think some great early stage firms where you're just working with amazing people, and it really comes down to the people. So that's another big part of it.
Maybe one additional thing I'll add is just, be process ready. Make sure you have a very clear process, making sure that your data room is, all clean, that, you have a cohort analysis, you have your P&L, you have examples of investor updates. How do you communicate? How have you communicated? What do customers say about you? And again, number one thing is traction, traction, traction. Can you show that forward-looking repeatability, that vision, that velocity going forward? And just having that just organized. I sometimes am surprised when, I've seen, not our companies, because our companies are all ready, and we have a bit of a boot camp around it. But, when I've seen, some of our friends who are founders, just not having a lot of that process discipline and that organization, because I think that goes a long way, especially when you're pitching to a lot of these great Series A firms.
Yeah, look, I think the converse is true too for all the founders out there. Be super picky with who you partner with. Ask yourself, make them take you out to dinner, and at the end of it, ask yourself, hey, even if we fail, would I go on this journey again? Odds are it's still at the Series A not going to work, right? But maybe it's the next time you start, right? And that if you pick that right partner, they'll back you again. I just backed someone where he failed spectacularly, we said, no problem. You've learned a lot from this experience. We will back you again. And he wanted to partner with us again. Call them at weird times too during the fundraising process, right? They should pick up immediately. If you call on a Saturday, if you call during dinner time, and you can hear whether they're excited to hear from you or not. But it's a two-way street, and make sure you're enthusiastic about partnering with whoever is at that firm.
Okay, I will do audience questions. There's a mic runner.
Dominic, I'll let you.
Okay, so someone has the mic. Okay, where? Oh. Probably someone in the firm, yeah.
So the ratio of pitches you get to the actual investment, it is 1 to 100 or 1 to 1,000. And there are so many criteria and factors. If you have to pick one factor that helps you make the final call, the final judgment, which startup to invest in, what would that one factor be?
For us, it's consistency. And so, just again, there's a reason why we like to build these relationships early on, is because it does give us a little bit of a reference point in terms of, does a founder or CEO just deliver on what they say, or if, they're working through sort of how they want to shape their vision and what the future is, we can see kind of that progress. And, we end up missing rounds early, and that, ultimately we don't want those conversations to preclude us from being able to have that, that shot in the future where you've delivered. And there's amazing investments that have worked out really well for us and for the founders, where we didn't lean in at seed and A, but we did at B, and went on to be very successful.
I'd add for us. Oh, sorry. Do you want all of us or one of us?
Oh. Was it the, okay.
I'm sorry, I was just
for all of you.
one very quickly, traction, of course, but just uniqueness, and, is it kind of out there? Is it bonkers? Is it a bit of an outlier, kind of a newer thing? I think that tends to get a lot of attention as well.
Can it be huge, right? I mean, our LP has a different criteria. They're the most cash-generative business in the world, in history, and so it's we need it to be enormous, right? And so then the second question is, can this person actually go and execute on that vision?
I have a question about markets opening up and generative AI. I'm over here. Hi.
Oh, hi. Oh,
So I'm the founder of a consumer legal tech company, and I saw how generative AI completely cracked open that market. Are there other examples of markets where you really wouldn't have been very excited about the market until generative AI came along, and now it's completely changed your vision of that market.
I mean, look, there's a lot of net new surface area that's emerged from this, and this is what I was talking about before, where, you know, if you look at the selection of 80% of the AI, generative AI companies that we've brought to our investment committee over the last year or two, they're actually, again, addressing white space, net new product surface area that didn't exist before, as opposed to, you know, displacing an existing market or incumbents. So for us, that's super exciting, the shape it takes. You know, it really varies by vertical to vertical, and you know, I think we're looking for something that's more than just a scribe, you know, and it actually takes the workflow and does something unique with it.
Mind if I-
Oh, hi. My name is Dylan Murray. My team is trying to be the face of at-home consumer diagnostics, and we're a startup battlefield company. We're also all 21 years old and trying to raise a $6 million seed. How do you guys think of young founders? How do we compare against founders that have that lifetime experience that you love?
I think it's an asset. I mean, I think that this is, you know, very much early stage venture is often a young person's game, that you have the energy and the drive and kind of the lack of other sort of life distractions, right? To be able to, you know, plug in so much time and so much energy. So, you know, play the cards you're dealt. If you're young, like, go hard. If you're a little bit older, play your experience. But, you know, I think you have a great shot at it. For what it's worth, I do feel like 6 million seeds are pretty big. And I have a horse in this race, but I do often believe that, you know, smaller rounds just to get started and just to prove where you're at and taking less dilution, like, do that. You want to run really, really fast, and don't let really big seeds slow you down.
Hi, way back here. For those that are doing something that is different, edgy, you all have all mentioned it, or unseen perhaps, what is the #1 tip you would recommend a founder share in a pitch deck to articulate a new emerging market that's not currently out there and seen?
I think it's not losing that enthusiasm. Like you said, part of it is like, the harder it is, the more speed dating's involved. And so I think we're all reticent of like, this is gonna be very hard. And so being upfront of like, I wanna acknowledge this is hard. This is why I think we can get over it. And I always joke that like, I've done both sides of this, like Thomas, where like private equity is like math and science, but very early stage is more like religion. Right, and you have to make me believe that like you recognize how difficult this is going to be, but all the seed deals and Series A's we do are still very difficult at that point. It's convincing the person in the room that like you can get over that hump and how you accomplish what you set out to do.
Thank you very much for the insightful discussion. I have an unusual question. My name is Vail Babajov. I'm founder of Video Engager, Video Chat. Also, I've been early stage investors. I've been on both sides. And the question is, do you have examples of really successful companies that are bootstrapped? They didn't use any funds.
I mean, one prime example for us is a business called Veeam Software. The founders bootstrapped that business to, I think, close to $200 million of revenue before they took any capital, outside capital. And I think it just speaks to, if you've got great product market fit and a great technology, you know, capital to grow is not necessarily what's going to build the moat.
And I think we have time for maybe one more question.
Oh, okay. Can I? Oh, sorry.
Right
okay.
here. Hey.
Hi, my name is Masha Petrova. Our company is Null Space. We are not an AI company, and I feel like it's time that we can actually advertise that now. We're developing computational software. I have a question for Thomas. You mentioned working with analysts. So we just closed our Series seed round, and as a founder, I get inundated with emails from junior people and analysts from VC firm. Your analyst from Insight Partners has been awesome and is very knowledgeable and asks all the right questions and clearly prepared, but you get slammed with emails from some just junior analysts sometimes that are not prepared. How do you balance answering those emails, taking those calls as a founder? Do you have any tips on how to sort of filter, if at all, or do you just take all of them? I appreciate the answer.
You'll have to calibrate a little bit based on your own experience. But look, this is the challenge from our side, is we know that it's a very competitive landscape and that we're not the only firms with an outbound team. And so showing that you've done your homework and have a point of view and a perspective, and you're not just sending a very bland form email, because that's not going to get a response. But we really look at ways that we're going to build like a thoughtful connection with the founder. And I tell my analyst team, you're building your own portfolio. You're betting your time on this company, and it's going to be 3, 4, 5+ years potentially before it becomes an investment. Sometimes it happens sooner in the AI world. Those cycles have been compressed. But that's where, when you have the call, do they bring a thoughtful perspective, and they have kind of a unique sort of vantage point on the market, and that that sort of, you should be getting something from it as well. If you're not, then probably not a relationship to prioritize.
And that is all we have time for. So thank you so much for coming, and thank you to the lovely panelists.
Thanks for having us.